Have you ever heard about inflation, but feel confused? Don't worry, you're not alone. Inflation is a term that gets thrown around a lot, but what does it actually mean? And more importantly, how does it affect you, your money, and the economy? Let's dive in and break it down in simple terms. Inflation is the rate at which the general level of prices for goods and services rises, eroding the purchasing power of money. It is usually measured by indicators like the Consumer Price Index, CPI, or the Producer Price Index, PPI. Inflation can be caused by factors such as increased demand, higher production costs, or excessive money supply. The impact of inflation on the economy. When inflation rises, the economy experiences various effects. Reduced purchasing power. Consumers find that their money buys fewer goods and services. Higher interest rates. Central banks, like the Federal Reserve, often raise interest rates to combat inflation, making borrowing more expensive. Erosion of savings. If inflation outpaces interest earnings, savings lose value over time. Wage price spiral. As prices rise, workers demand higher wages, leading to further price increases in a self-reinforcing cycle. Inflation doesn't impact all assets equally. Some benefit, while others suffer. Let's take a closer look. Stocks. Inflation can be a double-edged sword for stocks. Some companies, especially those in sectors like energy and commodities, benefit from rising prices. However, high inflation can hurt growth stocks, particularly tech companies, because rising interest rates reduce the present value of their future earnings. Bonds. Bonds are highly sensitive to inflation. When inflation rises, central banks increase interest rates, causing bond prices to fall. This is because the fixed interest payments from bonds become less attractive compared to newly issued bonds with higher yields. Real estate. Real estate often serves as a hedge against inflation. Property values and rental income tend to rise with inflation, preserving the purchasing power of real estate investors. However, if interest rates rise too much, mortgage costs increase, potentially slowing demand. Commodities, gold, oil, etc. Commodities, especially gold and oil, often perform well during inflationary periods. Gold is seen as a store of value, and oil prices tend to rise with inflationary pressures. Cryptocurrency. Some argue that cryptocurrencies like Bitcoin act as digital gold during inflation, as they have a fixed supply. However, their volatility makes them a risky inflation hedge compared to traditional assets. Inflation also has macroeconomic consequences. Reduced economic growth. High inflation can slow economic growth as consumer confidence declines and businesses face higher costs. Increased uncertainty. Businesses and investors become more cautious due to unpredictable price changes. Debt repayment becomes easier. Borrowers benefit because they can repay loans with money that has lower purchasing power. Inflation is a powerful economic force that influences asset prices and the economy in multiple ways. While it can erode purchasing power, increase borrowing costs, and create uncertainty, smart investment strategies can help navigate inflation's effects. Understanding how inflation interacts with different asset classes allows investors to make informed financial decisions.